This is Brad Sanders. This is your investment update for April of 2020. Okay, so kind of the polar opposite of March. We had a great month in April. The S&P was up 12.8%, global equities up 11%, and then we had um, domestic bonds up 1.8% and global bonds up 2%. So kind of a complete mirror image of what happened in March. What caused the market to rise so much in April, even in the face of really, really bad economic data and a continued shutdown of the economy to the largest extent, was the Fed stepped in and did unlimited quantitative easing, and then has done plenty of other programs where they're buying everything from corporate bonds to high yield bonds to mortgages to some municipals, and they're really supporting the bond market. And what that does is it allows the bond market to remain liquid, dealers to take positions, and that market to trade uh, more rationally. And what was happening in March was the bond market was acting irrationally. We had corporate bonds down 20% in a few days. And when that happens, the selling spills over into the equity market because large pensions and large holders of bonds try to get bids on their bonds and they can't, so they're forced to sell equities even though they don't want to. So by the Fed stepping in and kind of providing a put to the market, it allowed it to start functioning more rationally, and we got a kind of a reflexive rebound in the market where we retraced a lot of the drop. We do believe the market is now kind of retraced back into an area where it's not really reflecting true economic activity. The economy is the weakest it's been since the Great Depression. Unemployment data is very bad. Manufacturing data is really bad. There's supply chain disruption. We also saw what happened to the oil market as an example of an industry that's had a supply and a demand shock. And so we have a kind of an economy that's very, very soft, and there's a lot of unknown and uncertainty going forward. But we've had the market keep going up because of all this liquidity from the Fed. So we expect, given that backdrop, that we're going to have continued high volatility in the market. We saw it this week already. And going forward, that should be a baseline expectation for the coming months until we start seeing how reopening works, start getting some light at the end of the tunnel on how this shutdown is going to, how long it's going to be. Are we going to get a second wave? There's just too many questions to answer. And so we expect markets to remain very volatile day to day. And some days it could look like we're in a new bull market, and then the next day it could look like it's going to go all the way back down again, and vice versa. And that's just going to continue to happen. We do think the volatility we saw in March is largely over, where you have the double-digit swing days, 10% down one day, 10% the next. That's over. Once the Fed announced what they did late in March and early in April, that should keep a lid on that kind of volatility, which is a good thing for all of us. We don't want that kind of volatility. It scares people, and it makes it really hard just to operate as financial professionals. This kind of volatility we're seeing now, while much higher than it has been over the last several years and almost a decade, is much more manageable, and it's much more easy to operate and kind of easier to digest on a day-to-day basis. So that's our kind of baseline expectation, is expect more volatility. Earnings are going to continue to come out, and we expect the market to be more fluid and to have, several down periods, several up periods until this is all over. But until then, we continue to stress, risk management, staying put, not doing anything drastic. Certainly don't operate with fear, be more rational, and talk to your planners and talk to us if you have plenty of questions, and we'll talk to you next month.